Welcome back to another episode of CAPIVI. This week, I think I'm going to leave the camera off, and that's just because it makes a lot easier to make the video. And the less I'm fussing with editing, the more content I can provide in terms of analysis, and that's the value I want to bring. I want to bring good information above all else. That's always been the priority of my channel. I just, I don't care much about pleasing people. And that's always been a problem for the popularity of the channel and its growth. But I don't care. Here we go. So AMC recently has formed a partial rise in this massive corrective pattern, which I have shown in blue. Once again, I'm going to try to do my best to make this kind of like a podcast. So if you don't want to open the charts or don't want to have your screen to your face, you want to take your eyes off of that screen, you want to close your eyes, you want to sit back with a J on the chair in the lawn, just having a good time, you can do that. Put your phone down. I'm going to try to talk you through this. Here we go, one step at a time, starting way back in May of this year. We found a low at 970, and I'll say it once again, called that bottom perfectly days before it happened as a vertical rundown ensued. From that time forward, we've seen a slight uptrend with a bounce near 1030, and then once again, another bounce near 1109. That's a pretty short range from 970 to 1109. So you have $2 there. And that happened about over the span of a month. So that trend line is actually pretty shallow. And that upward trend, that's the bottom of an ascending broadening wedge, which in Elliott waveform speak is a reverse triangle. And this one is actually technically diagonal, and that's because it's not flat. It's coming up a little bit, hence the ascending broadening wedge. Here we go. The top of that pattern is formed very early by the peak we saw at 1613. Now this was a point of much hype, of a lot of hype, and I said, no, this is going down. Of course it did, naturally. And the trend line that formed there hasn't been encountered since that point in time. There is a downtrend from the all-time high, and it kind of cuts through the top of that trend line. What is that, in about July? And so as the price came up bouncing off of that low near $14 when this big run just started, this big hype run started, that trend line interrupted that run within the pattern. And that's what's creating this partial rise. And so on the charts, I have this labeled out quite clearly as a 335. I've been following this pattern for a long time, for most of this pattern actually. And I've adjusted the medial line that I have running through it. It's a blue dashed line now if you're looking at the screen. And you can see how important that level is, and how the top of that third wave of the 5 pattern, which preceded the big run, rejected at that medial line, and how that medial line has now been the support through which the price has recently broken and is now plummeting below. So this 335, it consists of 2 corrective waves back to back, one up and then one down. I have those shown in yellow, labeled ABC. Corrective phases are always labeled in letters. What starts next is a very gradual motive wave. It's very gradual, and it was that 5th wave that extended and pushed higher. Frost and Pressure in the Elliott wave principle, that's the book I'm always talking about, posting about, reading. They state in there that when you have a 5th wave extension, that the retracement is brutal, and this fits that bill. They say typically you find support around wave 4 of the extended wave, which here was 5, and we've already broken down below that level. This has been an amazing analysis, and yes, I called the top of this 5th wave run like 3 times, and none of those were true, and that's because the wave extended, and that's just the way it goes sometimes. If I get every run, every little pop, and I get every little dip right up until that one point in time, I'm happy. Because once we hit that top, I said, this looks like a top. And then sure enough, it became a top. It became a double top. That has now confirmed. And there's actually a price target towards $16. I don't know what drawing set I have it on. I have so many drawings. Okay, here we go. It's actually on default. And there are actually some old price targets back here in June and May that never were filled. I think the symmetrical triangle we saw at the beginning of this corrective pattern, that looks like its target was reached. I'm just gonna go ahead and delete all that. Don't need that on the chart. It's cluttering that up. What you can see here on the daily chart from that big explosive run to 27.5 is a very clear double top. And when you pass that intermediate value between the two peaks, guess what? Pattern confirms it's true. And now we're looking for a target at 1639. Looking at the daily, there is definitely a bullish doji here. 100% bullish doji. There's nothing wrong with that. But, you know, I'm going to start calling out Trey. I really am. And I think that's because it's just that there are so many people that are buying into that hopium and are now bag holders and are now stuck in the vicious meme stock battle. And if you're here, you were probably a part of that at one point in time or another, so was I, and it wasn't good. So I have currently drawn the bullish abandoned baby, and to get that, you're going to have to see at first a gap up, and then a massive surge over a significant level of support and resistance. And how on earth am I supposed to expect that's going to happen when the implied volatility is now negatively correlated with the price? You can see that when the price was running earlier this month, that the implied volatility came up with the price. And then it fell flat as the price reversed. And now we see that the implied volatility is increasing as the price drops, which means the implied volatility correlation with the price has flipped. And that is a very big deal. I think that it's probably one of the best indicators you can have of future price momentum is which way implied volatility is correlated with the price. And if you can catch those flips, that can be a huge leading indicator. And I guess technically it's lagging because, you know, the price had to dump from 25 down to 19 before that correlation flipped. But now that it has, we can definitely start to read into it. The RSI is now below 50, and it does look like we're losing some momentum as the decline in the RSI begins to round and kind of pull up. So we're looking kind of at like a slope here, almost like a ski slope, where if the enthusiast was on the slope, they'd be almost level now. So it is possible that, guess what? We move sideways. Yes, sideways. I fully anticipate moving sideways, and it may even come after a bounce up to about 21. I think that $20.73 level, I think that's a pretty good spot to have the price recover to. I was thinking 21 would be good. And I choose that level for a few different reasons, but let's just save this as default. I think that would create some hopium, catch a bunch of bulls, and then we'll see the price move down and just start to consolidate. And I don't know what the amplitude of these waves are going to be, but I suspect it's going to be grindy and dumb. And if we are going to see a pattern, it'll probably be some sort of pennant or triangle. So it just depends on the time frame there. Remember, pennants in Bulkowski chart pattern analysis are shorter than 3 weeks, and triangles are longer than that. And it's important to remember that. You can forego those time frames if you have solid Elliott wave analysis, but if you have the Elliott wave analysis, you might as well use Fibonacci or harmonic patterns to determine price targets instead of Bulkowski's chart pattern analysis. So that said, let's hop into this chart just a little deeper. Let's look at the 15-minute. And oof, I have after hours on currently, and I'm looking at, is this possibly a diamond through here? Now, when I say through here, I told you that I wasn't going to make you pick up your phone, but you might need to here. I am looking at the price action from Friday, and geez, I just can't turn off these arrows. I know that when I'm pulling up a sub-menu, you can't see that, so I'm just like clicking randomly on the screen. There might actually be a diamond through here, like really. And if that's true, that could very well be like, do you see that diamond? Eesh, that could be a continuation pattern. And if it is a continuation pattern, we're going to hit that double top target, 1639, no problem, Monday morning. With the dividend, of course, which is, of course, a stock split. It hurt my head looking at, so I've been on Twitter lately, because I'm kind of considering bringing some level of activism to my channel where I am beginning to really believe that people in general are being taken advantage of. That the Moaz myth machine is designed to take money from the retail trader. And I go into that in my Discord and how that's possible and how FTDs, FTD warehouses, how the clearing houses and the brokers can just take your money and give you nothing in return while you hold a depreciating asset. And who knows if AMC is going to be able to turn a profit ever. They didn't do it last quarter. I've been saying it for the longest time. Until AMC can turn a profit, do not count on that squeeze. Because the logical thing to do is hold a short position while a company is not making money. Why? Because it will eventually go out of business. And what Adam Aron has done now is bypass the voting base of his company in order to sell equity to raise money to keep the business open. Think about that long and hard. This is a travesty. I'm oh man, it's bad. Let's go ahead and open up CAPIVIsion here. I think I've got this labeled out. Yep. And we're going to turn off after hours now. And what I'm doing here is I'm going to start analyzing this almost perfect Elliott wave forecasting I did over the last week. And the way I got here was to assume that we had reached the peak of a fifth wave extension and started a zigzag down. And so that decline from $27.50, that initial run down to $21, and again, that $21 level is important. I think that was a motive wave. It looks like a motive wave. And then we had a corrective phase higher, which was a measured move up. So there's actually two little motive waves in that push from 21 back up to $27, and that's where that second top and the double top formed. From there, I believe we started seeing that third wave extension start to occur, and that third wave extension is everything. Frost and Pritchard, they say, just get into the habit of drawing that third wave extension. As soon as you see that motive wave occurring, just start extending that. And so that's what I did. And when that happened, I came up with this incredible forecast that the price would just push straight down to $17.65, and it did that. It did, like exactly that, which was insane. Frost and Pritchard for the win. And so the question is now, where does this fit in the overall analysis? Well, the relative direction is down now. It's officially down because we've set a downtrend, and I'm going to add that downtrend to this chart. You can see the downtrend from the all-time high in that big red dashed line. Well, guess what? Now we've got another downtrend to break through, and that will have to be defeated before we can get back up to that other trend. Insane, right? So there's that trend line between the two. Well, it's not really the second peak, but you know what we're going to do is we're going to take this downtrend that I just drew, and we're going to apply it just to that decline from last week, that brutal, massive third wave. And you can see that when I do drag that trend line down, and I don't overwrite the price anywhere, that there's actually a wick on an opening candle on August 17th. And that means that this trend line is defined. This trend line for the whole week was defined by the closing hours and the opening bell of August the 16th and the opening of the 17th. Literally just a couple of hours defined that downtrend. And the price has been respecting that. So currently, the price is beginning to grind sideways as it did on Friday, and it looks like it's about to challenge this uptrend. And I'm actually expecting this uptrend to break. Robert Lindelhoff, there you are, dude. Welcome. I mean, you've been here a long time. I know you've been here a long time. So, I mean, I think you've been on my charts before. Here we go. So I am expecting a wave 4 breakout. I am. And that wave 4 break would be the fourth, let's see here, minuet wave. Now, when I do my annotations here on Elliott wave, I have a very particular way of doing it, and Frost and Pritchard do as well. And while I respect the way Frost and Pritchard do it, I also add my color scheme to the different degree notations that are provided in that book. So yellow is smaller than blue, and blue is smaller than white or gray. And that color sequence is steady through the three different levels of degrees and their sub-degrees. So there are 9 degrees. From top to bottom, you go sub-minuet, then minuet, then minute. And those three, I kind of bundle those three together. They're the minute waves, right? Minute, minuet. It's like a diminutive form of the word minute, and then sub-minuet. It's like a double diminutive. So you understand how sub-minuet's yellow, and then minuet's blue, and then minute is white. And then I continue that with minor, intermediate, and primary, which is the next 3 degrees moving up. And so in that sequence, minor is yellow, intermediate is blue, and primary is white. And then we go into cycle, super cycle, and grand super cycle. And the color scheme's the same there. And I typically don't get that high in my charting. I'm looking at a 15-minute chart. Really, you're supposed to find sub-minuet waves on the 1 hour. I prefer the 15-minute just to get that definition. It's easier for me to spot those waves. And I think I can argue that high-speed trading is a modern thing and that the wave principle needs to accommodate that as well. So while I don't like to apply the Elliott wave theory to the minute chart very much, I zoom out to the 15 to really verify those counts. So here we go. Did you follow that? I explained all that just to say that was a motive wave down on the sub-minuet time frame shown in blue. And what I'm expecting now is a wave 4 of the minute degree. And so in Frost and Pretcher's book, they label their minutes they do the numbers, but inside the circle. And I can't do that on TD Ameritrade. Wake up call, TD Ameritrade. Hey, how about some Elliott wave analysis tools, huh? It's only the most popular freaking form of analysis, and you don't have the freaking tools to do it. I mean, come on, TD Ameritrade. They're also messing up their charts. This is a good time to remember to go over Grom and Party and Root. Those are kind of like the community picks right now. Obi-Wan likes to pick them, and then I like to buy them. Just a little bit. It's fun. It's really, no one is under any obligation to do anything. Really, we're all responsible for our own trades. Yada, yada, yada. Not financial advice. Blah, blah, blah. I'm vlogging here. So, wave 4, minute, where should that come up to? Well, the answer is it could come up to the bottom of wave 1. And look at that. Right there. Wave 1 bottomed at 2073. And that was the push down, the end of the first sub-minuet motive wave off of that 2750 high. And if you can understand what I'm saying right now, props. Because this is not easy. This is like CAPIVI level 401. This course is going to take 20 hours a week. But really, you can see the value in it. I mean, I just keep telling people, I've perfectly forecasted this. I call it the top, and I call it double top, wait patiently, forecast the downtrend, call it the 30-wave extensions, all confirmed now. And now it's like, maybe people should start to understand that this analysis is the way. Wyckofians, yes. Wyckofians got something right once. Great. But what about the Bukowski and Elliott wave analysis? It's been right since May, right? Okay, with the exception of the 5th wave extension, which I did miss, but whatever. 5th wave extensions are bogus. Like, not bullish, because the pullback's so harsh. All you get is this top. Like, you get a 5th wave extension, you're finding a top. Good luck finding MOAS out of a 5-wave extension. That does not seem right. So now we have this big topping pattern. And bounce up to 21 is probably going to be wave 4. I would personally expect that to happen in some sort of flag formation or pennant. And it might take all week. Yep, might take all week. So after a stock split, what's the price of AMC going to do? Well, it's going to divide by half, so it's going to go down to $9. But it's also probably going to consolidate for a while. I imagine that there's going to be a lot of people who are disillusioned with why they bought into the stock, and they're going to sell it, and market makers are going to take advantage of that. But I can personally see a big measured move down forming off of this 3-wave. So we get this 4-wave to be a corrective phase in the measured move down, and then we get a second leg. And what's really going to be interesting is when I duplicate this trend line from that recent high last week, and I apply it to the top of that corrective phase, that level, and I look down, how far down does the price appear to go? $12. So if we do get this measured move down to complete this cycle, that's how far to go. But I don't actually expect that, because this first wave from 27.50 down to 21, that's like a $6 run. And when I look at wave 3 is much taller than that. It's much taller. If the wave 3 went from 26 down to 17, so $10. So, it's almost roughly twice as long as this first wave. And typically you only get one wave extension. So it's common that wave 5 actually is equal to wave 1 in both amplitude and time. So what I just did on the chart was I dropped a high, or a line down from the high of 27.50 down to the end of that first motive wave at 21. And now I'm going to take that height. I'm going to apply it. And when I do that, what do I get? 13. It's similar, very similar, but I'm confident sub 15 or wait, $7. Took the stock split, but we got there, sir. Jeez. So that's what I'm expecting. Yup, there's more downside. Now, for a reversal to occur, it is possible though, listen to this too, it is possible that this is still just a corrective downtrend in an overall larger uptrend. That is possible. Elliott waveform analysis does not buckle and fail when an account breaks down. It just requires revision. So if this is just a corrective push down in a bigger wave, like let's say that this whole, this is where the bullish talk starts, and this is the hopium, and this is what I'm not going to be like pumping out there online all day, but I'll say it in CAPIVIsion. So it's possible that you had wave 1, and I'm doing this now on the chart, so look at your screen. This is from $11 to $18. That could be 1, 2, 3, and this could be wave 4, right? You can see that this decline from that double top could be wave 4, because in this analysis, wave 1 tops ultimately at, let's see here, what is that top? Well, the close was at 17, the high was at 1837. Right, the 1837 level was really important for stock ed, and this is why. And yes, the price did push down below there, but it didn't close. It didn't close below the wave 1 close. Where was one wave's close? The highest close in wave 1 was 1773. And so I would say stock ed, your count survives until we get a close below 1773. So that should make you happy. I think this is important to know because the price bounced. Let's see, where was that bounce at? 1750, and what was that close at? 1773, or the close was at, I'm sorry, 1752. Wow, closed at 1752 and bounced at 1750. 2 pennies. Yeah, and I'm calling for a bounce right now. So there is a possibility that this survives and we still are missing wave 5. However, if that is true, then wave 3 started at 1368, reached 27. That is the extended wave, and wave 5 will probably match wave 1's amplitude and time, probably. And let's see, what would that get us? That would get us back up to $25 in late September or early October. And that would involve another test of that big downtrend. And really what AMC would be doing then at that point is making a massive triangle. And that wouldn't necessarily be bullish either. So that is to say that count can survive still. It can, but it's just probably not as likely as seeing another push down to 13. And what that would do is actually create this head and shoulder top. Let's see here. I think I was showing this on the 15-minute, wasn't I? Nope. I wonder what that was. Was it this one? Yeah, it was this one. You can see that, I have the price showing here coming down to that bottom trend line of the ascending broadening wedge, which would be $15. Like 15 is a really safe target right now, but I do think we'd have a bounce, and maybe we do dip. If we dip and then bounce up to 18, that'd give us a good right shoulder. And then if this plays out, of course, we take the height of the head to the neckline of that pattern, the head, shoulder, top, and we apply it downward, and like it's, oh my goodness, $2.50. So this remains to be seen though too, which means that the price of AMC is actually currently in a great state of uncertainty, and the most certain thing now is actually a bounce, a little bounce. Doesn't mean we're going to the moon, but a bounce is likely. If we do get a bounce and we do get this downtrend test again, watch it very carefully. Watch it very carefully. I'm not going to say we're going to have a short squeeze of MOAS. I can understand why some bulls might be saying that, but I think understanding overall market conditions are important and will temper the overall forecast, because while AMC is actually, the technical analysis on AMC is very bearish. It's very, 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 very bearish. It's going to be very hard to establish that motive wave higher to make that old count survive. And the market conditions would not actually be conducive to that. So let's open up SPX. Let's segue into SPX here. I've been looking for the everything rally, and I have some counts up here, and you can see this. And this rally has been really good, and I did call it. Yep, and it went up. Great, of course. It's kind of like, oh, I was right about something. Who cares? you can see I have been kind of expecting this kind of a move. Showing on the charts here of SPX, you can see I have a line drawn from the all-time high coming down to the lowest low in 2022, and then a move higher, and then another leg down. What I'm trying to express here is that the bear market could possibly be just beginning. It really could be just beginning. Let's pull up the, blank chart. It's not really a blank chart. So I have a hard time though, because I do believe this is a leading diagonal triangle we see now, and I have revised this. Let me turn this onto the 1 hour chart here. And let me zoom in too into this pattern. There's like a leading diagonal triangle in the beginning of it. And there's a 5-wave motive wave form, and it's actually got, it's a triangle, so it's not really a motive wave, but it is an impulse wave. And there was a correction after that, followed by impulse, reaction, and you can see that there's a 5-3-5 leading diagonal triangle, but we have had a downward breakout from that level, which is super interesting, and it happened like right at 431, which is where my target was. Yep, I nailed that too, and I got that pattern from the gap 2H, and that's actually an SPY. This is not SPY, this is the index itself, so it's not the same, but it's not dissimilar either. So what this says is that this could be the first motive wave in a push higher and a full reversal of the bear market into a bull market. I think the price will come down to at least 41.86. Or the index will fall to 41.86 before staging that reversal. It's very likely, though, that this is just the beginning. And I say that due to the wave form that I'm observing. And this morning I fussed with it and I expressed it all in SPY. And this is the chart I really wanted to show and talk about today because I spent forever building this thing. Oh, yes. Yes. If your head is spinning, take another toke, have a drink, sit down, because this is a beast analysis of Elliott wave theory. Okay, so let's start with the top. You see that I have these arrows lined up here, and basically what I'm trying to express here is what kind of waveform I'm looking at throughout time, and each of these lines has a little arrow, and so you can easily see how trend reversals occur where the waveform changes from motive to corrective, motive, corrective, motive, corrective, motive. And we currently just came to a corrective, the end of a corrective phase, I believe, which means we could start another motive wave, which would be very terrifying. There are two possibilities here. And so I have this gray box kind of right now at the very end of the chart. I'm like, there's a zone of uncertainty between 431 and 393. Because if the price falls to 431 and if it finds support, then it's possible the market could be bottoming. I say that because, let me just draw a line. Let's say the price falls to 431, then the price stays above its first wave. This I have this labeled as a minuet wave 1, and if it can go higher, then wave 5 could double top, but it also gives the price a chance to stage another reversal, right? Kind of like buys times for the bulls to bounce at 393-ish. It doesn't necessarily mean the bear market's over, but it gives them a chance, which creates uncertainty. Likewise, the price will have to rise above 431 before we can really establish that the price isn't topping. Because when I take that first height and amplitude of wave 1 and I measure it and I compare it to wave 3 of this supposed bullish count, which would be 1, 2, and we've just recently found a top of that wave 3, the difference in height between wave 1 and wave 3 implies that wave 3 extended, which means wave 5 wouldn't. So we take wave 1 and then we say, hey, if it were to make a full retracement and then bounce back up, look at that. SPY would drop to 393 and then bounce back up to 425 and make this perfect second test and double top at that downtrend, which we started from last year. It wouldn't be until the price could set a new high that it would actually break through that downtrend. And that's why I have this zone of uncertainty labeled here, because the price could do any number of things within this gray box and not make any clear indication as to what is actually happening next. Insane. It's insane. I can see it really going either way. And people are like, oh, it's gonna go up or go down. Like, yes, it's gonna go up or go down. But the point is once it does reach a significant level, how far up and how far down will it go? And so if the price can break above that zone of uncertainty at 431, how high could it go? And the answer is, well, that could be the end of the bear market. Okay, so there's your answer. If we can get above 431 and not top, but see a surge in volume and strength at that point, yeah, bear market's probably over. However, if it doesn't, this is where it gets a little scary. And I hope that by bringing a forecast to some knowledge here to light that could explain how that could happen, it could take out some of that uncertainty that creates that fear and maybe keep some heads cool, because this is natural. This is okay. I think we found the top of a super cycle, and we're going to talk about that super cycle too. Yeah, we're going to go to SPX really quickly here before to justify why I'm calling for such a bearish thing, which I haven't even revealed yet. But let's just go ahead and have a look at this. Turn on the weekly max. Okay, so here we go. Geez, what is this? That's got to be a cycle wave 3 and a cycle wave 4. You can see this in green, and we found the top of that cycle wave 3 in 2000, and that dot-com bubble, that's what started this corrective phase that lasted about 10 years. And yes, that corrective phase, that cycle wave 4 did last just about 10 years before we saw a breakout in 2012, 2013. So that's why I'm calling for a decade-long correction cycle. And you can see how many times the price dipped between 2000 and 2002 before finally forming a triple bottom. Like, that must have been just a terrifying experience. And then even once the markets did rally and come up higher, guess what? They didn't break new highs from the dot-com bubble in 2007. You know what happened in 2008 and 2009. Insane, right? And I'm thinking we're in a similar position now, except instead of like financial, well, I think the financial markets will have a hard time because of the abuse in the systems, but I think climate change is actually going to start having an impact too, and geopolitics. I think so. I think both those things are going to create supply chain. Yeah, supply chain. Yeah, get used. That's not going away. Get used to that. Okay, so we cycle wave 4 ended 2011, and we had cycle wave 5 form, and I think the 5th wave of that cycle wave, as I say, the primary waves, it's possible we saw an ending diagonal triangle through here. Can you see that? I understand that's very hard. Look at your screen if you're not. Pick up your phone, put your sunglasses on. It's possible that this is an ending diagonal triangle. It's just very poorly formed. Maybe if I took off log scale, it might look better. Yeah, it would look a little better in arithmetic scale. And it's important to, it's important to do both because Frost and Petrus say so. That's all I know though. 1, 2, 3, 1, 2, maybe 3. This becomes the bottom. 1, 2, I don't know, not significant low. 3, 1, 2, 3. Yeah, I don't know. It could be some form of ending diagonal triangle, and it's just distorted because the Federal Reserve was buying the living daylights out of stuff. I never really understood what they were buying. I mean, it doesn't matter. They've started to unload their balance sheet. And why aren't people talking about that anymore? Anyway, so let's talk about cycle waves. So if cycle wave 5 ends, like what would be a healthy retracement of that 5th wave? Let's go to the bottom of 4, and it's like you don't even get to 61.8% until like 2,200. And let me draw this upside down too, because this is how I actually like to do it. This is how I actually like to do my fibs. I like to put 100% at the top. That makes sense, because it's like we're trying to find what point of the rally we're falling down to. And 61.8 falls at 3,200. Okay, and on this chart, I actually have this giant zigzag drawn out, and this could happen. Like this looks like it's what's setting up. This looks like what's setting up to me. You can see there's this inflection in the RSI here on the weekly time frame. Right here, and that's an inverted hammer on SPX. Yikes. So let's open up the SPY chart again and talk about how this actually could be achieved with the current wave count that we have. And let's pull it back up to a yearly time frame and zoom back in. And it's okay. So in a corrective phase, you have motive waves when they agree with the higher degree. And a good way to do that is just to identify the prevailing trend. And so I have that here in this red dashed line. And so motive waves point down until they break above this line. And so we do have a motive wave through here that we started on July 14th. But I believe that this motive wave is still corrective. It's part of a 335 pattern, which is a corrective pattern. So it's okay because it is agreeing with the degree of one higher. And so at this level, I drew that motive wave in the sub-minuet form, and it's actually agreeing with a sub-minuet, or I'm sorry, a minuet or a minute wave. So it can be up. That motive wave can form up. And it may be an impulse. It may be the first of an impulse, but only if it breaks that prevailing downtrend, which it's not doing. There was actually a test of that downtrend on 816 and a rejection. And that occurred at 431.73. And, you know, I was looking for 431.54 or something like that. Let's actually pull up that chart. I don't know where I did that analysis. We're just going to flip through here until we find it. It might have been on the RADBF. Nope. And you can see that on this analysis, we've had actually a pull back up into the pattern, which is pretty likely. And there's a lot of different analyses that you could do here. And you can see like even these old retracement levels are coming into play. RSI study. Is it drawing board? Is it, let's see here, blank? No, this was a falling wedge that I was trying to build, but I don't know. We've probably found that falling wedge target if we did find that. Where is this? I think I might have deleted my gap to H analysis. That is too bad. I'm actually kind of upset about that because I thought it was a good analysis. Anyway, here we go. So we have a zigzag down, 1, 2, 3, and it's possible that these first three waves from that high at the beginning of 2021 and to the low of 2022, that this has been just a complete A, B, and C move, and now we're going to see a push higher in the markets. In which case, this impulse, this recent rally is just the first wave of 5 going up, or the price actually failed to break that downtrend right there. And so what that indicates is that we're actually going to be fractaling into a bigger downtrend, in which case I have these labeled as minute wave 1 ending near February, minute wave 3 coming up into the end of March, beginning of April, and then the minute wave 3 ending at about mid-June. And this bounce, the everything rally, is actually a 4 wave. And this is crazy because the first wave down, the first motive wave here, its lowest low, let me think here. Because I have one at this low, but actually I think it's right here. 1, 2, 3, 4, 5. Yeah, so you can see that there is some overlap. I'm just going to drop a box down between wave 4 and wave 1. Wave 1 being down, wave 4 being up and recent. And, you know, I've seen that to be actually an occurrence that's normal. It doesn't happen very long. And so, like, if you look at that motive wave graphic I sent out a while ago or posted, I say that you don't have that overlap without a reversal. You have to, because Elliott's analysis was based on cash accounts and cash markets. These are not cash markets. And Frost and Pretra acknowledge that when you do have derivatives markets, that, yeah, the price extremes can be overlapping like that. And so what I tend to observe is that there's a lot of congestion, a lot of gapping, a lot of weird candles if they do overlap, and that's exactly what we see between these levels. And there is a knot right here, early June, just below it. So that 420 level is actually very important. It's very important. I was expecting a dip till there, and we have reached that. So it's time for this motive wave to either continue upward or start to make us really worried about a bear market continuation. Because if this is a zigzag and this is a 4 wave going up and it doesn't break that, this zigzag analysis dies and just becomes a motive wave down. And if it's a motive wave down, then we have to have a 5th wave. And if that 5th, and if the 3rd wave down didn't extend, which doesn't look like it did, like if you ask me, wave 1 came from 480 down to about 420. And then wave 3 came from 460 down to 380. So like wave 3 was a little bigger than wave 1, which is fine, but I don't think it was large enough to constitute an extension of the wave. And that makes me believe that if wave 1 and wave 2 didn't extend, that wave 5 will extend. And if wave 5 extends, it's going to be nuts. So I just took the amplitude of wave 1 and pumped it and pushed it down onto the high of wave 4. Let's assume we get no extensions. It's still ridiculous. I have that shown in this white line here with a blue line. And so this is the amplitude of wave 1 applied down here. 313 to 430, it's like 100. That seems like a lot. You know what we're going to do? I think it's actually the amplitude of wave 3. We're going to duplicate this, and we're going to try to figure out where I got this this relative height from. And it's, wow, it's huge. Why did I, oh, because I took the height of wave 1 and wave 3 together and said that would be our total height of a wave 5 extension, which is a pretty good way to do it because the extensions typically may be as long as those other two motive waves. And this is all Frost and Pretcher stuff. It's all in that book. So if we do get that extension, then, you know, we're looking for 313. That's a huge dive. That's a huge dive. And that would just be a motive wave. That would just be the first complete motive wave. That's not even where the pain would end. That would be where the downtrend stops before we get a big ABC correction. And that motive wave would probably take the rest of the year. And then the ABC correction would probably take another couple of years. And then the next motive wave would probably, let's just assume that it would match the amplitude and height, or the height of that first zigzag down. Okay, and let's just apply the measured move down theory to it. And let's say the ABC correction comes, you know, it just depends. If the ABC correction comes all the way back to the all-time high, then the next dip won't be as bad, but it'll be near that low that we're going to find this year. But if we do get like a true measured move down and we don't see a new high, it's possible we go even lower, down to like 265. This is what I'm talking about. This sounds crazy. But if you look on a big enough scale, it actually makes a lot of sense. And I don't see why we should be worried about it, because the industry that we've established on this planet is destroying the planet. And so we've kind of got to start over in a sense. Not entirely, right? But, you know, let's turn on the yearly time frame. Let's get this thing shown in years. Aggregation period, years. Okay, this has been our bull market from the Great Depression going onward. It's insane. Look at how big it is. And if you want to put a trend line here, you're probably going to look at this. These first 2 years, or not first 2 years, these first 2 points though, between what year is this? 1940 and 1920. Like, that uptrend comes way up here, and we're nowhere near it. To get to that trend line, we'd have to get down to like 500 or 600 on SPX, which would be like 50 on SPY. Let's take this out of log scale, and this is probably going to be different. Look, tell me that this didn't go straight up. Stock market went straight up from 2008 till present, and is now forming pipe tops on the yearly time frame. And if we do get this big zigzag down and do find that low later this year, we're going to be analyzing pipe tops on the yearly time frame, and that price target is going to be low. It's going to be very low. Again, I don't think this is end of the world sort of stuff. It's really not. Like, it's just a change to the status quo. And I mean, that is nihilistic for the paradigm, but it's not nihilistic for existence. You know what I'm saying? So here we go. This uptrend through here, let's see how long it would take to get to here. Sorry, my charts are kind of like dirty at this level. They're a little cluttered, but I wasn't intending on showing them like this. But anyway, this zigzag coming all the way down to this trend line would still be at like 3,000. There you go again, 3,000. So that 300, 325, maybe. Like, I mean, look at the RSI on the yearly time frame. Wow, what we reached last year? 87 on the yearly time frame. Jeez, that's insane. No bearish divergence, of course, but it is quite notable to see it up that high. Pipe top. So yeah, that's why I'm saying we could see another, like, a continuation of this bear market, and it would be long and it would hurt. And what do you think AMC and the meme stocks are going to do in that kind of environment? What do you think consumer discretionary is going to do in that environment? It's going to tank. It's going to tank. And that's why I'm wondering if these short positions that we see around the market are as large as they are. They aren't large because it's greed. They aren't large because they can't exit the positions. I think it's possible they're large because it's a massive amount of money entering a massive position trade, and that the position is short the top of the market because the markets are actually going to tank like crazy still. And then once we get down to that real level of peak fear, I guarantee you the level of fear we see at 300 will make the levels of fear we had in 2021 look like a toddler throwing a fit. Because I gotta tell you, in 2008, I remember people jumping out of buildings. And that's horrible. That's horrible. Are we anywhere near that kind of a crisis? No, nowhere near. We're just coming off the highs. In a big perspective, this downtrend is nothing to complain about. Especially now, right? Being up at the 430 levels when the high was at 479, we're not even 100 points off the all-time high on SPY. Yeah, so I see a potential for the bear market to continue. This is the time right now for the bull market to start to get back on its legs and to start moving back towards the all-time high. Or it's going to be bear market time. Meanwhile, China continues to build its navy, continues to practice military drills around Taiwan. Meanwhile, Russia continues its war with the Ukraine, and that tension escalates. While we have supply chain issues, while we can't get the CPI under control, while our Congress continues to just legislate trillions of dollars into existence from nothing as housing prices soar, as pollution goes off the hook. This is the environment for a bull market? I don't think so. So buckle up, get ready, learn how to make money in a bear market. That's what I'm here for. I'm going to be the truther. Meme stocks are probably going to get wrecked, and then if there is going to be a MOAS, it'll be at the bottom of this next leg, and it is going to be the dip of our century. Okay, getting off my soapbox. This is all for CAPIVIsion today. It's a lot of charts I didn't cover, but also I think that I'm at 46 minutes, so it's going to take me 4 hours to get this video processed and exported and uploaded. So for now, that's going to be all. Stay safe. You're responsible for your trades. Remember, there's a lot of people out there that want you to believe everything that they say for some reason, and it's probably not for your benefit. Okay, I'm out of here. Happy trading.